Hey, Brett Kitchen here, and who is a good steward of your money? I'm going to read you a definition real quick of what the word steward means. It says here in Webster's dictionary online, the careful and responsible management of something entrusted to one's care. Okay, so the careful and responsible management of something entrusted to one's care. So as we're looking at our wealth and our retirement specifically, who is the best steward of your money in the financial services industry? You basically have three options, right? You've got Wall Street and the traditional investing methods. You've got the banking world. You've got the insurance world. So those really are the three biggest kind of options. Now, real estate is a part of its own thing, and you certainly can manage real estate and just control that yourself. There's not really a stewardship there. That's more of a self-directed investment. And that works fine as long as you're cognitively able to do that or have the energy or the wherewithal or the interest in doing that. Not everybody does as they age. Not everybody does at any time. And so if that's not you, then really you're back to the three options. And so if you just look at those three and say, okay, well, how do you rank stewardship? How do you rank these three entities based on the careful and responsible management of your funds? And let's just start with banking because that's easy. It's easy to understand how banking works and how trustworthy they are at responsibly managing your money. And if you don't know or haven't heard of fractional reserve banking, then that's something you can look up and check it out. But basically what it means is for every dollar that's on deposit with them, they can lend out some fraction or some multiple of that and keep only a fraction of it in their actual bank at any one time. So you put $10 in, they're going to keep $1 in the bank and they're going to lend out 9, but your account is going to say that you have $10 in it. Well, what happens when you want your $10 and your neighbor wants his $10 and everybody that banks there wants their money at once? Well, that's what we call a run on the bank. That's what caused over 10,000 banks to fail during the Great Depression. And it's still the reality that we live in today. It's actually also why the banks suffered so badly during the real estate crash of 2008 is because they had multiple debtors that did not pay their debts. And so therefore they failed. Now, banks are not necessarily a great retirement option anyway, because typically all they can do is offer CDs, which are only going to pay you a pittance compared to what you can get elsewhere, and of course not keep up with inflation. But if you're talking about careful and responsible management, you've got the FDIC insurance up to $250,000, and then you've got the fractional reserve system that is really quite shaky at best when they're stress tested. The next one is of course Wall Street. And so how good is a Wall Street type investment at carefully and responsibly managing your money? Well, again, it depends on how you define careful and responsible management. Is it, well, this money is going to be there for me when I need it? If so, then what guarantee do they give to you that it will be there when you need it? If you put, 100 grand in your bank account, you would expect that when you go to get the 100 grand out, that it's there, right? Because you know that that's kind of the way that banks are supposed to work, right? They hold the money there for when you need it. You put 100 grand in a Wall Street investment type account. What will it be a year from now? We don't know. What will it be 5 years from now? They can't tell you that. So there is no guarantee of any kind. There's not even an assurance that you can get your money back when you need it. Is that what you would consider to be a good steward? I'm not saying they're wasting your money. I'm not saying they're stealing it. I'm just saying, is that careful and responsible management? If you know you need that money to live on during retirement, then how does it make sense to put it into a scenario where you don't know and you don't know what it's going to be? So that's basically what you're faced with the Wall Street system is you have no idea. Everybody says it's going to go up. You just have to believe them, but you don't know that because if you happen to retire this year when the market's down 25, 30%, literally this morning I just talked to a gentleman who had 1.2 million. Now it's down close to 800,000. He's retiring next year. Think of how costly that is to somebody who's retiring next year. That's devastating. He may not be able to retire. He may have to work for another couple of years and hope that it comes back and continue contributing. Is that careful and responsible management? Not for me. I mean, it may be for you, but not for me. The third one is the insurance industry. Okay, everybody loves to hate on the insurance industry, and deservedly so in some respects. They have had a history of being difficult to pay claims and things like that. Largely, those have all kind of gone by the wayside as the internet proliferation has occurred, and people can, report their difficulties in getting paid. They're much more aggressive at paying people their claims on the property and casualty side, and on the life and annuity side, they are second to none in terms of reserved capital. So let me just explain how that works. With an insurance company, they are required to have more dollars reserved than all of their liabilities. And so when you go to an insurance company and you buy an insurance policy for $1 million and you've paid $500 in premium, well, they've got $1 million liability there. Okay, so that's on their books. They have to have the money to pay that. By the same token, if you deposit 500 grand for an annuity, they have to have more than $500,000 to pay their liabilities. And so they're not just one for one, they're usually over that. So if you compare that to banks, banks are a tenth of what you've put in. You put in that 500,000, they keep 50, they loan out 450, and then the next guy comes and deposits the 450 and they keep 45,000 and they loan out that the rest of the 405,000, and this just keeps going and going and going in the banking system. They rely on short-term loans from the Federal Reserve to pay the immediate needs, but if everybody goes at once to get their money, there's no money there. With the insurance companies, if everybody goes to get their money immediately, they have enough in reserve to pay every liability all at once. The other thing is they are not risking it, investing it in the stock market in variable accounts. They're putting it into corporate bonds, to government bonds, to A-rated type bond that will continue to pay a small but consistent return so that they can afford to pay out all of their claims all at once. Now, I'm not saying they're perfect. There may be those over the years that have been mismanaged and have had problems, but largely policyholders of insurance contracts, whether that's life or annuities, have never lost their money, in the respect that if one does have a financial problem, a lot of times they have a guarantee association or other companies that will come in, make the policyholders whole, buy the assets of that, buy the assets and the liabilities, and continue to pay out those claims. So if you're just looking to measure stewardship, careful stewardship, you've got banks with fractional reserve, you got Wall Street that you're basically guaranteed not to know what your money is, and then you've got the insurance industry that is guaranteeing over $1 for every liability that they have, and it's invested in safe, secure investments while they're working your money to build capital and return back to you. So those are three different options that you can look at, and maybe a different way of looking at who should I entrust with my money when I go to retire.